Most people think retirement is about slowing down, finding a nice beach, playing golf, maybe taking up watercolors. I never understood that. When I left Renaissance Technologies, people asked me, Jim, what are you going to do now? As if mathematics and science, the things that fascinated me at 20 would somehow bore me at 60, as if curiosity had an expiration date. Here's what they didn't understand. The human brain isn't a machine that wears out from use. It's more like a muscle, and muscles atrophy from disuse. I spent 40 years finding patterns in financial markets that most people said didn't exist. Made some money doing it, okay, quite a bit of money, but the real discovery wasn't about markets at all. It was the same mathematical principles that compound wealth can compound health, knowledge, and impact. Growth isn't a phase of life, it's a discipline. So today, I'm not here to talk about retirement planning. I'm here to talk about perpetual growth, because the most dangerous equation in life isn't market volatility or genetic risk. It's the belief that learning stops, that contribution ends, that the best work is behind you. I've watched this happen in my own life repeatedly. I started as a mathematician, moved into code, breaking for the government, then academia, then finance. People asked me at each transition, why are you starting over? But I wasn't starting over. Every field I entered multiplied the value of everything I'd learned before. The pattern recognition skills from mathematics made me better at markets. The statistical thinking from markets made me better at evaluating scientific research. The discipline of scientific research made me better at philanthropy. Here's the critical insight: this compounding accelerates with age, not despite it. When you're 20, you have enthusiasm but limited connections between ideas. When you're 40, you have expertise, but maybe you've narrowed too much. But at 60, 70, 80, if you've stayed curious, you have this vast network of knowledge where everything relates to everything else. You see patterns nobody else sees because you're pulling from disciplines that don't usually talk to each other. I'll give you a concrete example. At Renaissance, we hired physicists, astronomers, mathematicians, anyone but financial analysts. Why? Because people trained in finance all thought the same way. They had the same mental models, read the same books, attended the same conferences. But a physicist looks at market data and sees particle behavior. An astronomer sees orbital mechanics. A speech recognition expert sees signal processing. None of them are right in some absolute sense, but each lens reveals patterns the others miss. The same principle applies to personal growth after career. When I shifted focus to philanthropy and science funding, I wasn't leaving mathematics behind. I was applying everything I'd learned about systems, probability, and pattern recognition to a new domain. How do you identify promising early stage research? Same way you identify market opportunities, look for asymmetric risk-reward ratios. What makes a good scientific collaboration? Same thing that made Renaissance work: diverse thinking, rigorous methodology, freedom to fail. But here's where most people get retirement wrong. They think learning is preparation for doing. You learn in school, then you do in career, then you're done. That's a fundamental misunderstanding of how human capability works. Learning isn't preparation, it's fuel. The moment you stop learning, you stop compounding. And when you stop compounding, you don't plateau, you decline. I'm in my 80s now, and I promise you I'm learning faster than I did at 30. Not because my brain is quicker, it's probably slower in raw processing speed, but because every new thing I learn connects to 10,000 things I already know. It's like the difference between having $1 earning interest and having $1 million earning interest. Same rate, wildly different absolute returns. This is why I find the concept of intellectual retirement almost offensive. It's leaving your most valuable asset, an integrated, cross-disciplinary knowledge base built over decades, to atrophy. It's like spending your whole life building a powerful telescope and then refusing to look through it at the most interesting part of the sky. The mathematics here are actually quite simple. If you learn something new every day, and each thing you learn makes future learning easier and more valuable, you're on an exponential curve. Stay on that curve long enough, and the returns become extraordinary, not in money necessarily, though that can happen, but in impact, in understanding, in the sheer pleasure of seeing connections nobody else sees. So when people ask me about staying sharp in later life, I tell them, I don't think about maintenance. Think about compound growth. Your brain at 70, properly invested, should be vastly more capable than at 30. Not despite your age, but because of it. That's not optimism. That's mathematics. When I was running Renaissance, people would ask me about my investment strategy. They wanted the secret formula, the magic algorithm. But the real secret wasn't complicated. Find edges that others miss, quantify everything you can, and never stop testing your assumptions. After I stepped back from active trading, I realized something curious. I was applying exactly the same methodology to my own body. Most people treat health like they treat their car. Something breaks, you take it to the mechanic. You're reactive. You wait for symptoms. Maybe you do some basic maintenance, oil changes, annual checkups, but fundamentally you're operating on gut feeling and conventional wisdom. That's fine for a car. It's a terrible strategy for the only body you'll ever have. Here's what quantitative thinking teaches. You can't optimize what you don't measure. At Renaissance, we tracked thousands of data points across global markets, looking for tiny inefficiencies that added up to significant returns. The human body generates even more data, but most people ignore 99% of it. They step on a scale once a month, maybe get blood work annually, and call that monitoring their health. That's like trying to trade the stock market by checking prices once a year. So I started measuring, not obsessively, but systematically. Sleep quality, heart rate variability, cognitive performance on standardized tests, inflammatory markers, metabolic panels, the works. And just like in financial markets, patterns emerged. Things I thought were unrelated turned out to be tightly correlated. A poor night's sleep didn't just make me tired. It degraded my mathematical reasoning 2 days later. Certain foods that were supposedly healthy caused my inflammatory markers to spike. Exercise timing affected my sleep quality, which affected cognitive performance, which affected decision-making. This is where the investment framework becomes powerful. In finance, we talk about risk-adjusted returns. You don't just want high returns, you want high returns relative to the risk you're taking. Health works exactly the same way. Take supplements, for instance. The supplement industry is a mess of unsubstantiated claims and placebo effects, but approach it like a quant. What's the evidence? What's the mechanism? What's the downside risk? What's measurable? Suddenly, you can separate signal from noise. Vitamin D is a great example. Solid mechanism. It's actually a hormone, not a vitamin. Clear deficiency pathways, easy to measure. Low risk. Significant percentage of population deficient, especially at northern latitudes. That's an asymmetric bet. High potential upside, negligible downside. Compare that to some exotic herbal extract with one small study and no clear mechanism. That's a lottery ticket, not an investment. The compounding principle applies here too, and it's even more dramatic than with knowledge. Small improvements in multiple health domains don't just add, they multiply. Better sleep improves exercise recovery. Better exercise improves metabolic health. Better metabolic health improves cognitive function. Better cognitive function helps you make better decisions about sleep, exercise, and nutrition. You create a positive feedback loop, and suddenly you're not just maintaining health, you're improving it year over year in your 70s and 80s. But here's the part that surprised me most. The correlation between physical health and cognitive performance is far stronger than most people realize. We tend to think of the brain as separate from the body, as if it's running on some independent system. That's completely wrong. Your brain is the most metabolically demanding organ you have. It's exquisitely sensitive to inflammation, blood flow, glucose regulation, oxidative stress. When I optimized my cardiovascular health, my mathematical problem solving improved, not because I was thinking about health, but because I'd literally improved the physical substrate that does the thinking. This is where conventional retirement planning fails catastrophically. People save money for retirement, but let their health deteriorate. They're planning to have resources, but no capacity to enjoy them or use them productively. It's like carefully preserving your wealth while letting your ability to read or think or move atrophy. What's the point? I look at longevity research the same way I looked at market research, with rigor, skepticism, and an eye for probability. Most of it is garbage. Some of it is promising. A small fraction is actionable right now. The key is distinguishing between them. You need the same intellectual discipline you'd apply to any complex system: separate marketing from mechanism, correlation from causation, theory from evidence. The beautiful thing about treating health as an investment portfolio is that you can continuously rebalance based on new data. Blood work comes back showing elevated homocysteine. Adjust your B vitamin intake. Sleep tracker shows poor deep sleep. Experiment with temperature, timing, or supplements. Cognitive testing shows verbal memory slipping. Increase specific types of cognitive exercise. You're not guessing. You're iterating based on feedback. People talk about aging gracefully as if decline is inevitable, and all you can do is accept it with dignity. That's defeatist nonsense. Decline in certain domains is inevitable. I'm not going to match a 20-year-old in reaction time, but overall capacity, that's negotiable. And if you approach it with the same rigor you'd apply to any other complex optimization problem, the results are remarkable. Not magical, not easy, but achievable and, frankly, fascinating. When I sold my stake in Renaissance Technologies, a journalist asked me what I'd do with my time. I said I'd focus on mathematics education and basic science research. He looked puzzled and said, "But you've already done mathematics. Don't you want to do something completely different?" That question revealed a fundamental misunderstanding about how pattern recognition actually works. See, most people think expertise is narrow. You become good at one thing by excluding everything else. And there's some truth to that during the accumulation phase. You need focus to build deep knowledge. But once you have that depth, something interesting happens. You start seeing the same patterns everywhere, and retirement becomes less about stopping and more about recognizing where else those patterns apply. At Renaissance, our edge was finding correlations that seemed absurd on the surface. Currency fluctuations correlating with weather patterns in agricultural regions. Trading volumes predicting price movements 3 days later. The key wasn't that we were smarter than other traders. We just looked at data they ignored. We found signal in what others dismissed as noise. Now apply that same lens to the phase of life people call retirement. Everyone sees the obvious pattern: career ends. Activity decreases, relevance fades. That's what the data appears to show if you look superficially. But I've always been suspicious of obvious patterns. They're usually artifacts of how you're measuring, not reflections of underlying reality. So I started looking at people who remained productive and engaged into their 70s, 80s, 90s. Not just professionally productive, intellectually alive, curious, growing. And a pattern emerged that nobody talks about. These people weren't doing less, they were doing different. More importantly, they'd stopped optimizing for the metrics that define conventional careers, salary, title, recognition, and started optimizing for leverage and impact. Here's what I mean by leverage. When you're building a career, you trade time for outcomes. You work on this project, it succeeds or fails, you move to the next one. Linear relationship. But once you have resources, and I don't just mean money, I mean knowledge, networks, credibility, you can shift to exponential modes of impact. You can fund 10 research projects instead of doing one. You can mentor 50 mathematicians instead of solving one problem. You can design systems that keep producing value long after you're gone. This is pattern recognition at a meta level. I spent decades finding patterns in markets. Now I'm finding patterns in how scientific breakthroughs happen, how mathematical talent develops, how good ideas propagate through academic communities. It's the same cognitive skill applied to different domains. And because I'm not constrained by needing to generate immediate returns or satisfy a board or publish papers for tenure, I can take risks that active researchers can't. The Simons Foundation funds high-risk, long timeline research that traditional funding sources avoid. Why can we do that? Because I recognize the pattern from finance. The highest expected values often come from asymmetric bets that most players avoid due to institutional constraints. A young researcher with a weird idea about autism genetics. Conventional funding says no, too speculative, too likely to fail. But I've seen this pattern before. Most outsider ideas fail, but the ones that succeed can be revolutionary. The math works if you can afford the variance. Here's the part that surprises people. This phase is intellectually harder than running Renaissance, not easier. When you're trading, the feedback is immediate and quantifiable. You make money or you don't. When you're trying to accelerate scientific progress or improve mathematics education, the feedback loops are years or decades long. You need to recognize patterns with much noisier data, much longer time horizons, and much more uncertainty. That's why the conventional retirement model is so wasteful. You spend your entire career developing sophisticated pattern recognition capabilities, learning what works and what doesn't, building intuition about complex systems. And then right when those capabilities are most refined, you're supposed to stop using them. It makes no sense. I look at my current work the same way I looked at market opportunities. Where's the inefficiency? Where is everyone looking at the same data and missing something important? In science funding, the inefficiency is obvious. Institutions are risk-averse, politically constrained, and optimized for legibility over impact. That creates massive opportunities for private capital deployed intelligently. In mathematics education, the pattern I see is that we're teaching 19th century mathematics using 19th century methods to students who need 21st century skills. Nobody disagrees with that diagnosis, but changing large educational systems is hard. So where's the leverage point? Fund alternative approaches, measure outcomes rigorously, and let the data drive adoption. The same pattern-finding methodology that made Renaissance successful applies everywhere. You need good data. You need to test hypotheses rigorously. You need to be willing to be wrong. And you need to act on what the data actually shows rather than what conventional wisdom suggests. People think retirement is about rest, but if you've spent your life getting good at finding patterns that others miss, retirement is actually when you have the freedom to pursue the most important patterns of all, the ones that might take decades to prove out but could matter for generations. That's not retirement. That's just removing the constraints that prevented you from taking your biggest swings. There's a wonderful irony in how I built Renaissance Technologies. We became the most successful quantitative hedge fund in history by hiring people who knew nothing about finance. Mathematicians, physicists, computer scientists, cryptographers, anyone except Wall Street veterans. My partners thought I was crazy at first. Why would you hire a particle physicist to predict stock movements? The answer is diversification, but not the kind they teach in business school. Everyone understands you shouldn't put all your money in one stock. That's portfolio diversification. What people miss is intellectual diversification, the idea that your cognitive portfolio should be as varied as your financial one. And just like in investing, the correlation between your knowledge domains matters enormously. When I was younger, I moved between fields in ways that looked random to outside observers. Pure mathematics at MIT and Berkeley, code breaking at the Institute for Defense Analysis during the Cold War, back to academia at Stony Brook, then into quantitative trading. Each transition felt like starting over, and plenty of people told me I was diluting my focus. Conventional wisdom says you pick one thing and go deep, be the world's expert in algebraic geometry or number theory or whatever. Stay in your lane. But here's what I discovered. Knowledge domains aren't like stocks where diversification necessarily reduces returns. They're more like technologies that create value through combination. A smartphone isn't valuable because it's part phone, part camera, part computer. It's valuable because it's all three simultaneously. The magic happens at the intersections. At Renaissance, we'd have a mathematician who understood stochastic processes working next to a physicist who understood signal processing working next to a computer scientist who understood machine learning. None of them would have solved our problems alone, but together they'd see patterns that were invisible to any single discipline. The physicist would say, "This looks like noise filtering in radio astronomy." The mathematician would say, "That's just a Markov process with these properties." The computer scientist would say, "What can test that hypothesis with this algorithm?" Suddenly, you're making money from patterns that entire floors of MBAs missed because they were all looking through the same lens. I apply this exact framework to how I spend my time now. The Foundation funds autism research, origins of life research, mathematics education, theoretical physics, computational biology, domains that seem completely unrelated. People ask why we're so scattered. Shouldn't we focus on one big problem? But that question assumes problems exist in isolation. They don't. Here's a concrete example. We fund basic research into cellular automata and computation theory. Sounds abstract, right? Pure mathematics with no application. Separately, we fund neuroscience research trying to understand how autism affects neural development. Completely different fields, except last year, researchers using cellular automata models made a breakthrough in understanding how small genetic variations can cascade into large-scale differences in neural architecture. The mathematical framework from one domain unlocked insights in another domain that seemed totally unrelated. You can't plan these connections in advance. That's the whole point. If you could predict which disciplines would intersect productively, everyone would do it. The value comes from maintaining genuine expertise across seemingly unrelated areas and waiting for the patterns to reveal themselves. It's the same strategy that worked in markets. Position yourself where you can see correlations others miss. This gets more valuable with age, not less. When you're 30, you might have depth in one area and surface knowledge in a few others. When you're 80 and you've been genuinely engaged across multiple fields for decades, you have depth in 5 or 6 domains. The number of potential intersections grows combinatorially. It's like compound interest, but instead of money earning interest, its ideas cross-pollinating with other ideas. I'll spend a morning working on mathematics curriculum design, thinking about how to teach algebraic thinking to middle schoolers. Then I'll have lunch with a neuroscientist studying learning disabilities. Then an afternoon meeting about computational approaches to protein folding. These aren't distractions from each other. They're feeding each other. The neuroscience informs how I think about mathematics education. The mathematics informs how I evaluate computational biology proposals. The biology raises questions that send me back to mathematical foundations. People dramatically underestimate how much cognitive capacity you retain if you actually use it across multiple domains. There's this myth that your brain slows down, and you need to narrow your focus to compensate. That might be true if you're trying to compete with 30-year-olds at pure processing speed. But most valuable thinking isn't about speed, it's about seeing connections. And that capability increases with the breadth and depth of what you know. The traditional retirement model says, you've been doing 5 things, now do one thing really well. That's exactly backwards. You've spent 40 years building expertise across multiple domains. Now is when you leverage all of them simultaneously. Now is when the physicist, mathematician, trader, educator, and you can see patterns that pure specialists in any single field will miss. This isn't about being a dilettante or dabbling in everything superficially. It's about strategic depth in multiple domains. Each field you master doesn't just add to your capability, it multiplies it by enabling you to see patterns across boundaries. That's not a luxury. In an increasingly complex world where the most important problems don't respect disciplinary boundaries, it's becoming essential. The question isn't whether you can afford to maintain expertise in multiple fields after your primary career. The question is whether you can afford not to. I've made more money than I could spend in 10 lifetimes. That's not a brag, it's a logistical problem. Once you have a certain amount of wealth, the question stops being, how do I make more? And becomes, what does this actually do? And that's where most wealthy people get it completely wrong. The conventional approach to legacy is essentially passive. You accumulate wealth during your career, then you die, and your estate distributes it according to some plan you made years earlier. Maybe you endow a building with your name on it. Maybe you create a scholarship fund. Maybe your foundation keeps making grants decades after you're gone, guided by mission statements you wrote when you were alive. It's wealth preservation extended beyond death. I find that approach almost offensively wasteful. You spend your entire life developing judgment, pattern recognition, and domain expertise. You learn what works and what doesn't through painful trial and error. You build intuition about complex systems that can't be codified in grant guidelines or investment committees. And then you die, and all of that dies with you, leaving behind only the money. That's like building the most sophisticated trading algorithm ever created and then unplugging it to let a simple rule-based system manage the portfolio. You're throwing away the most valuable asset, not the capital, but the intelligence that knows how to deploy it. So I've approached legacy completely differently. I'm not waiting until I'm dead to figure out what matters. I'm actively deploying capital and judgment right now, while I can still learn from the outcomes and course correct. The Simons Foundation isn't a posthumous monument. It's a live research operation that I'm deeply involved with, making decisions, evaluating results, adjusting strategies. This matters more than people realize. When you fund scientific research, you're making bets on people, ideas, and approaches in conditions of extreme uncertainty. Nobody knows what will work. The data is noisy, the timelines are long, and the conventional signals, credentials, institutional prestige, preliminary results are often misleading. This is exactly the environment where experienced judgment matters most. I can look at a researcher's proposal and recognize patterns from my trading days. This person is asking for funding to test a theory everyone else thinks is wrong. That's potentially interesting. Contrarian positions with asymmetric payoffs. This lab wants money to collect more data before forming a hypothesis. That's how we operated at Renaissance. Let the data speak before you commit to a model. This group wants to explore 3 different approaches simultaneously. That's portfolio thinking. Maintain optionality when you're uncertain. None of this appears in standard philanthropic frameworks because it can't be reduced to rules. It requires judgment developed over decades of making high-stakes decisions in uncertain environments, and that judgment degrades rapidly when you're not actively using it. You can't write it down in a mission statement and expect a board to execute it faithfully 30 years later. Here's what really drives me the problems I'm funding now: understanding the origins of life, mapping the brain, advancing mathematics education, probing the fundamental nature of the universe. These aren't going to be solved in my lifetime. I know that. But the research I fund today determines what's possible 20, 50, 100 years from now. I'm not trying to see the finish. I'm trying to move the starting line for the next generation. That's a very different kind of legacy than a building with your name on it. A building is static. It either stands or it doesn't. But knowledge compounds. A young researcher I fund today might train 10 students who each train 10 more students who solve problems we can't even articulate yet. A mathematical insight we help develop might enable technologies that don't exist yet. The impact doesn't stop. It cascades forward through time. This is why I'm so skeptical of the set it and forget it approach to philanthropy. The most valuable thing I can contribute isn't my money. It's the combination of resources and judgment deployed actively in real time. When I die, the foundation will continue, but it will be different. It should be different. The people running it will have their own judgment, their own pattern recognition, their own sense of where the opportunities are. That's fine, but I'm not going to pretend that I can create a perfect set of instructions that will substitute for active engagement. What I can do is maximize impact while I'm here. That means staying deeply involved, making decisions, learning from outcomes, adjusting strategies. It means treating philanthropy with the same intellectual rigor I brought to trading, measuring what's measurable, testing hypotheses, being willing to fail, and scaling what works. People sometimes ask if I worry about being forgotten after I die. That's the wrong question. I'll be forgotten eventually, everyone is. The question is what persists. And what persists isn't your name on a building or even the specific projects you funded. It's the knowledge you helped create, the researchers you enabled, the problems you helped solve, and most importantly, the problems you made it possible for others to solve. That's not passive wealth transfer. That's active knowledge creation. And the difference between those two approaches to legacy might be the most important pattern I've recognized in this entire phase of my life. You don't build a meaningful legacy by preserving what you've accumulated. You build it by using everything you've learned to accelerate what comes next. So let me bring this full circle. When I walked away from Renaissance technologies, people kept using that word retirement, as if I was ending something, as if the most interesting work was behind me. They had it exactly backwards. Everything I've talked about today, the compounding of knowledge, the quantitative approach to health, the pattern recognition across domains, the diversification of intellectual pursuits, the active deployment of resources and judgment, none of this was possible when I was building a hedge fund. I was too busy, too focused, too constrained by the immediate demands of managing billions of dollars and hundreds of employees. This phase of life isn't a withdrawal. It's a liberation. For the first time, I can take truly long-term bets. I can fund research that won't pay off for decades. I can explore connections between fields that seem absurd on the surface. I can optimize for impact rather than quarterly returns. I can be wrong in interesting ways without answering to investors or boards. And here's what I want you to understand. This isn't unique to me because I made money in finance. The principles apply whether you're a teacher, an engineer, a doctor, or anything else. The compounding of knowledge doesn't require wealth. It requires curiosity. The pattern recognition across domains doesn't require a hedge fund. It requires intellectual breadth. The active approach to health doesn't require expensive interventions. It requires measurement and discipline. What does require resources is the willingness to reject the conventional script. Society has a very clear narrative about what your 60s, 70s, and 80s should look like. Slow down, simplify, accept decline. Hand things off to the next generation. Be grateful for what you accomplished and don't expect more. I'm here to tell you that narrative is mathematically illiterate. It ignores compounding. It ignores the exponential value of cross-domain knowledge. It ignores the fact that judgment improves with experience. It treats the human mind like a depleting resource when it's actually an appreciating asset if you use it. The tragedy isn't that people retire from their careers. The tragedy is that they retire from growth itself. They stop learning because they think learning is preparation for doing, and they're done doing. They stop measuring because they think measurement is for optimization, and they're done optimizing. They stop exploring new domains because they think expertise requires focus, and they've already focused enough. All those assumptions are wrong, and they're costly beyond measure. I'm 86 years old. I published my first serious mathematical paper when I was in my 20s. You know what the difference is between the mathematics I understood then and what I understand now? It's not incremental, it's categorical. The 25-year-old version of me couldn't even comprehend the problems that interest me today, not because they're harder, but because they require integrating insights from 6 decades of learning across multiple fields. That's not maintenance. That's not preservation. That's growth. Real, compounding, exponential growth. And it's available to anyone willing to reject the retirement narrative and embrace what I'd call the perpetual growth framework. Stay curious about everything. Measure what matters. Recognize patterns across boundaries. Maintain diverse intellectual investments. Deploy your accumulated judgment actively, not posthumously. The question isn't whether you can do this. The question is whether you can afford not to. Because here's the real secret, the one that took me decades to fully appreciate the most interesting problems. The biggest opportunities for impact, the deepest intellectual satisfaction, they don't come early in life when you're building expertise. They come later when you have enough expertise across enough domains to see possibilities that are invisible to everyone else. So don't retire from growth. Don't retire from learning. Don't retire from impact. The most dangerous calculation you can make is believing your best work is behind you. Trust me on this. I'm pretty good at math.